Mark Kiefer with Guild Mortgage Company. Thank you for watching this second part. It's the Mortgage Knowledge for Washington Real Estate Agents, part 2 of 3. My goal and my motto really is helping agents like you close more transactions by offering unique mortgage services and outstanding communication. I can be reached at 509-217-0600 or mkiefer@guildmortgage.net. The second product that I'm going to cover in this 3-part series is going to be the 97% conventional first mortgage with a 3% Washington bond second. There's no first-time home buyer requirement for this product. It's open to all Washington State owner-occupant borrowers, and really actually it's open to all areas in Washington State. All of these Washington State products are now open to everywhere in Washington State. There are income limits per county. Spokane County is $97,000. The maximum loan amount on this product is going to be $417,000. The minimum credit score requirement on this program is 660. And that's not a Washington State stipulation. It's actually a mortgage insurance stipulation, because this product does require some mortgage insurance, and there currently is no mortgage company that's going to finance or that's going to provide mortgage insurance to borrowers with a 659 or lower credit score on this 100% combined loan to value product. So that's really the only reason why the 660. Otherwise, it would be a normal 620. There's a silent second on this product, just like the FHA one, except for this one's going to only be at 3% of the loan amount because it's a 97% first. So it is a 0% interest loan due in 30 years. And the max seller contributions on this are only going to be 3%. So sometimes, if the loan amount's around $100,000, typically we're going to need a little bit more than that. So the borrower will probably end up having to come in with some money on a conventional loan like this at a smaller loan amount. At a larger loan amount, a lot of times we can get, if you're up around $200,000, a lot of times we can have that 3% is going to cover, most of, or if not all, of the borrower's closing costs. So it really depends on, the mortgage size and the house that they qualify for. But, 3% covers quite a bit, so definitely a good start. Most of the borrowers have a little bit of money, but they just don't have that 3 or 3.5% to put down. So that might not be a problem, but definitely something to keep in mind, because if they don't have any money to put down at all for their closing costs, it's probably going to be a better way to go with FHA. Now, if the borrower qualifies, if it's a USDA eligible area, the USDA mortgage product is really a better product than the Washington bond product. There's no first-time home buyer requirement on this program. It's open to all USDA approved eligible areas in Washington and Idaho, and really all over the U.S. There's a boundary map that you can find at eligibility.sc.egov.usda.gov. Go on that website. If you're a realtor, and you're working with a buyer who is qualified on this program, if you want to probably give them this website, and as they're looking at homes, if they're on borderline areas, definitely give them this, and let them look up those addresses and find out, hey, is this actually in a USDA eligible area or not? Because obviously if it is, it's going to be a better program. But even when you're going and looking at listing a house, and when you go to list that house, if you can just do a little bit of research up front and find out if it's in a USDA eligible area, and you can put that on your listing, when people are looking at that house, when they're shopping online and it says USDA approved, it saves the borrower a lot of time, and it opens more doors for you. And I believe it's going to help you sell these houses a little bit faster, because really the more programs that are eligible for that property are going to open up more buyers. So, that's stuff that I believe, realtors should definitely think about when they're listing a house. But on this program, there's going to be some income max. Basically, it's not designed for rich people. It's designed to help, basically populate rural areas a little bit more. And if you have too much money, it will disqualify you from the program. In Spokane County, the maximum income limit is going to be about $98,500 per household. But don't quote me on that, because really there's actually a form that I need to fill out that is on the USDA website that asks me, hey, how many people live in the house, how many of them earn income, what is their income, how many children are there, and it goes through a lot of questions, and it actually comes up with a specific amount per family depending on the dynamics of the family. So don't quote anybody 98,500. Let me look it up. Let's get them approved, and as long as they're under the income per their dynamics, then that's fine. They qualify. The maximum loan amount on this program is going to be $625,000. There's no minimum credit score required with the USDA product. As long as we get a approval from GUS underwriting system, which is really a unique dynamic underwriting system that USDA has that is different than Fannie Mae or Freddie Mac's or FHA underwriting guidelines. The acreage must only be 30% of the site's value. So sometimes when you get a property where you have more than 10 acres, that acreage starts becoming worth, as a percentage, more and more of the site's value. So, as long as the acreage is 30% or less than the site's value, then we're okay. I'm not saying that anything over 10 acres is going to disqualify, because it not necessarily will, but definitely something that we should look at and do some comparative market analysis. If your borrower is going to be buying a property that has 15, 20, 30, 40 acres, a lot of times that's going to kick them out of the program from the beginning. So it's definitely better to give the knowledge to that home buyer that, hey, this program is not going to this USDA program, even though it's in an eligible area, this really will not work for this house, because the acreage is worth 40% or whatever it is of the home's value, and that's going to kick it out of the USDA eligible. USDA is very specific. They don't want any farms. There's no maximum seller contributions on this product, so really the seller can pay as much as the borrower's closing costs actually are, which really is kind of nice, because even on smaller loan amounts, you can get 6% if you need to, or even 8% if you got a really low loan amount. So definitely covers whatever they need. Here's some of the boundaries. I primarily work in the Eastern Washington area, and I'm in Spokane, but obviously go to that website if you live outside of the Spokane area, and look up your area, find out where the eligible or really the ineligible area is, because really probably 99% of the real estate in Washington State is going to be eligible. Now this map is for the Spokane area realtors, and as you can see, from Deer Park, Denison, Colbert, Peone, Mount Spokane, Newman Lake, East Farms, really parts of Otis Orchards, parts of Liberty Lake, east of Harvard Road, Manitou, Valley Ford, really parts of Micah down south a little bit, parts of Marshall, really not parts of Marshall, all of Marshall, Cheney, Medical Lake, Fairchild Air Force Base, and west of Fairchild, west of the river, as you get up towards the northwest of the Spokane River, Riverside State Park, everything west of the river there, and then it's so. Also, some of the agents that I work with are licensed in both Idaho and Washington. So, if you're an Idaho agent as well, most of the areas between Coeur d'Alene and Spokane are going to be eligible. All of Post Falls, Rathdrum, and all around the Coeur d'Alene Lake and some of Hayden Lake, Twin Lake, Spirit Lake, Newman Lake, Hauser Lake, parts of Liberty Lake. 9 Mile might be opening up, parts north of that, and then beyond. But definitely, if it's on the border, go in there and just look it up on the address. But phenomenal program. And really, the difference on this program is going to be the mortgage insurance. So, obviously, it's nice that we can go 100% with Washington Bond anywhere in the state. But if it is in an eligible USDA area and the house qualifies and the borrowers qualify, the mortgage insurance is going to be 0.4% versus 1.35%. So really, on a $100,000 mortgage, that's going to be the difference of $1,350 versus $400 per year on their mortgage insurance. So what we do is we take that amount, divide it by 12, add it to their monthly payment, and that's what their mortgage insurance payment's going to be. So as you can see, the USDA product, if they qualify, is going to be a better route to go. Now, the best mortgage that anybody could really ever get if they want to go beyond 80% loan to value is going to be the VA mortgage. It's 100% financing. And really, the reason why it's so good is because there's no monthly mortgage insurance versus USDA and FHA. So really, all conventional loans are going to have some mortgage insurance beyond 80% as well. Those are different factors that it really varies, but some of the key differences in the mortgage insurance between these three products are that there is an upfront mortgage insurance premium on FHA, which is 1.75%. There's also a premium of 2% on the USDA product, and then on the VA product, you're actually at about 3%. And that does depend on some different variables, but basically those are the three differences. And really, the great thing though is even though it's a little bit higher on the upfront that has to be paid, there's no monthly, so it really does save them a lot of money over the life of that how long they typically have that mortgage insurance. And now FHA is mandating that their mortgage insurance on these 96.5% mortgages is forever. So over the life of the loan, it's definitely the best way to go. And really, if they can't go VA because they're not veterans, USDA, the better way to go. Now, some of the agents, like I said, that I work with are licensed in both states, so I want to cover this. And also, some people, that work in Washington are going to be referring people to Idaho, and vice versa, because of where we live. And there's a lot of that going on in the Spokane Coeur d'Alene area, because there's a lot of workers that work in one and commute to the other, or vice versa, because really it's only about a 30-minute commute from Spokane Valley to Coeur d'Alene, and so that's just the dynamics of where we live. So I want to tell you also about a really awesome loan with the Idaho Housing and Finance Commission. It's 100% combined loan to value. It's open to the public. Borrowers must not own any other real estate at the time that the loan is closed. But that does not mean that they have to be first-time home buyers, because they don't. As long as they don't own any other real estate when the loan closes, they're fine. They must have the proper paperwork when the purchase offer is made, and that's really probably the most important thing that has to happen for you real estate agents. If you have a borrower that wants to qualify on this program, definitely let me know, and I'll send you a packet that it's in PDF. You print it out, and basically the borrowers have to sign it, and they have to submit that with the purchase offer, because everything has to be signed around at the same time, or they will not allow us to have different dates on that paperwork. It's either going to be signed and dated the same as the original purchase and sale contract was signed around, or it's disqualified. The maximum income by county is going to be basically per person. It's a little bit low, but some people do qualify. In fact, actually, a lot of people do qualify. So, for the people that do qualify, it's an awesome program. One person family, $30,950. Two persons, $39,800. Three persons, $39,800. Four person, $44,200. 5-person, 47,750, and it actually goes up from there depending on the family size. So if you get somebody with a bigger than 5-person family, let me know. I'll look up the chart, find out where we're at on the maximum income, see if they qualify, and if they do, then definitely it's a great program. There are maximum loan amounts in this. For a one unit, it's $217,500, and you can see the other units. Most people are going to buy one unit, so I'm not going to go into all that, but it's right there. There's a silent second, just like it is with Washington State Housing and Finance Commission. It's a 3.5% second mortgage. It's actually a 96.5% FHA first, and then the second's at 0% interest fixed for 30 years. It's really called a silent second because they never make any payments. They'll never make a payment to this. Now, another stipulation that's a little bit different than Washington State is they do have a due on, move out, or sell clause on this. Washington State has a due on sale clause, but they don't have a due on move out clause. In Idaho, they do have a due on move out clause. If the borrower moves out of the house within the first 5 years, they do have to pay off that second mortgage, not the first. Otherwise, it's going to be due in 30 years or when they sell the house, whichever sooner. The maximum seller contribution on this product is going to be 6%, which is pretty nice because that should cover most of the buyer's closing cost, if not all. Other unique services that I offer, there's very few companies that can really offer this, but it's called a mortgage tax credit. This program allows 20% of the interest qualifying borrower's pay to be credited back to them as a tax credit. Alright, so for example, on a $200,000 home at 5% interest, the annual interest on that house is going to be $10,000 the first year. So we take the $10,000 times 20%, which is $2,000. The borrowers are going to get back $2,000 that first year as a tax credit. Now, every year after that, for the life of the loan, they're going to get a tax credit for 20% of the interest that was paid that year. So this really does have the potential of putting several thousands of dollars back into the pockets of these borrowers over the 30 years that they normally really wouldn't get on the normal, because normally they can write off 80% of the interest that they pay. This one actually allows them to also do that, to write off 20, or to actually get back as a tax credit for 20% of the interest that they pay. I can use the $2,000, whatever it is that they get back as a tax credit. I can actually take that and I can add it to their income for qualifying purposes. So if I take that $2,000 and I divide it by 12, I'm giving them an extra 100, and I don't know exactly how much, but it's going to be, money that can go back in. And then, so really this on a $200,000 house has the potential of being able to offer them an extra $30,000 in loan qualification. So as you can see, that's going to open up a lot of houses that they normally wouldn't even qualify for, making your job easier as a realtor, to help them find a house that they fall in love with. On a $100,000 house, it might pop them up to about $115,000. It's going to vary a little bit depending on the interest rates and the loan amount, but it's definitely a great service. Thank you for watching this. Hopefully I'm going to see you in part 3, where I'm going to cover how I get people financed with bad or even no credit, and even more great mortgage products that I really want to go over with you. So hopefully I'll see you in part 3. Thank you for watching.